not unless my competitors are all paved. I might discount my rate like a substantial amount, but if they're all full, then I'll probably toggle that up higher. Again, it's putting in those reps and looking at facilities and kind of creating your own metric and what you're, at the end of the day, you need to be comfortable with the asset and the investment. And I've bungled tons of deals, like tons of deals. And by doing that, it's really stressful and like demoralizing to do it. But each of those that I bungled got me that much closer to my next deal and got me that much quicker to analyze. I was like, fuck, I really messed up this deal. How can I not do this the same way next time and get quicker at pulling the trigger, figuring out the number? Like Chris, do basically what Chris said. Okay, great, you're not gonna sell to me, and moving on. So, yeah, like I said, I don't calculate the fee income. With my current underwriting, I'm trying to be a slightly conservative on rates, but kind of at market. Again, with everything going on, I'm seeing collections rise and delinquencies at locations, and I don't know how that's going to play out. We're all a little uncharted territory, and I don't want to be. I'm not in a position where I need to be pushing the buffer. If you're trying to do your first deal or trying to get out of your W-2, I would probably get into be a little more aggressive with my numbers, based on what I'll get into in a second. And I think you said you were doing all 3 and 5 year. I'm doing all 5-year debt right now. I think rates, and I could be very wrong, will either flatline or come back down a little bit. I don't
2024, baby.
Who you voting for?
Steve's wearing my shirt.
You pulling the blue lever, are you?
Yeah, go ahead. Keep going.
So I know this spreadsheet looks really overwhelming and complicated. I plugged 4 numbers into this sheet to get this number. And what I'm doing here is saying, okay, this is where I think it is at today. If rates continue to go up, this is what my worst case scenario will be, right? Like if I have up here, if I'm calculating a 7 cap now, and maybe rates go up in a year and a half, and it goes up to 8.5, what is my exit going to be, and what's my ROI, and am I comfortable with that? And it basically took Wagner's sheet, I made a couple modifications, and I made it so I just plug in the rate. The facility is 27,000 square feet, so I plug in 270 units, 10 by 10s at 90 cents a square foot, and it pumps out these numbers. And then I'll plug in the just the monthly payment if I'm. So, what I'm seeing a lot of people do, if you're raising money and taking on investors, right? You're when this is what I said. That's why I brought that up. I was calculating in an exit all my equity, which we should do, right? That's kind of part of our plan. But with the way everything's going, and you get stuck in this asset, you look at the bottom. This is something I started adding recently when I was pressure testing my deals, which is new to me, right? And I bring that up because I bought 6 facilities and wasn't looking at this bottom line number without an exit. I was only looking at these top 3 sections, which, you know, if you calculate if it's all cash, anywhere from 18 to 24%. And if you're with debt, whatever on the screen is wrong because my pro forma was fucked up, which I realized going through this presentation, which you should always double check your numbers.
Why do that?
Fuck it, let's go.
I'm in.
Did I get that right?
Yes.
All right, cool.
Nailed it.
So if you're using debt, right, and Ken always says it, and I think it's something really important to do, don't take a mediocre deal and sprinkle some debt on it to make it a good deal. Because we don't know where we're going. The last 5 years, 3 years, the market's made us all look smart. Interest rates have made us all look smart. COVID with migrations made us look smart. We don't know where we're going. It could be good, it could be bad, it could be the same.
Terry, real quick, you talked about, I want to cut you off for a second.
Yeah, you did.
Guys, we're definitely not eating lunch. As you talked about, the cap rates are going up, right? And everyone's like, well, oh, now my terminal value is going to be less. That's not necessarily true. If cap rates are going up and top line revenue is going up, and when I say cap rates are going up, they're going from 6 to 7%. They're going in the wrong direction based on what everyone's used to. But yet, the top line growth is outgrowing that and overcomes it. You could potentially still be in a positive situation. Even though top line goes up and expenses go up, your NOI on the bottom line is still higher than potentially what you expected. So even though it went from a 6 to a 7 cap, it doesn't mean you fucked up. You just don't know what's going to happen. And there's a good chance that top line revenue, as inflation continues, is going to follow along with that. You can't bet on it, and you should be concerned about it, but know that you might not have screwed up yet.
Yeah, and that's kind of where I'll get into the deeper after I make submit a contract and try to get it and then really confirm my numbers is, okay, well, I know I'm conservative in my underwriting in general. where do I really think this is going to be? What's the worst case scenario? And even if cap rates do rise and you exit and top line revenue doesn't rise, you know, you could still be at, in year one at an 8 cap, 6 to 18%, you know, if you were cash. The one thing that was interesting to me doing this is if you're these heavy value adds, the way a lot of guys do them 50-50, and the reason they do them is so their expenses aren't high, is because you see this, all these red numbers. I mean, you're highly negative, and I just don't buy deals like that up front typically, but it's interesting that, you know, I feel like some people aren't really cognizant of that and excited to get into the business, and it's just something to be aware of not to hurt yourself. The other thing that's a big factor is how you think. The one thing that I've only bought one facility like this, but the operator had software that they had, I think I talked to Chris about this too. You had one you were looking at that they had numbers. And they have all that history and the value of it. Like when they have real numbers, I could see that 8 people were moving in and 8 people were moving out, 8 were moving right back in. And then you can get really aggressive with your pro formas and taking advantage of that data and looking at the historical numbers. And if you look at the difference from the first one to the second one, there's a lot less red in the bottom just on the cash flow numbers because I ramped it up. Like what is the market going to provide you once you kind of dig into this, whether it's before contract or after? If you can go from 5 to 10 move-ins a month, and that could be in just rent raises if it's full. Like I just factor it all in the same, right? The spreadsheet calculates a cap, like at 90%. Like what is the ramp up going to be? What is the stabilization rate? That's going to be a huge factor on your ROI. And I think there's no right or wrong answer as long as you're not in the red. But what do you come from? If you're trying to get out of your W-2, get in and flip a fucking couple properties and get out. Like we all want that cash flow because it's like a warm blanket. It's comfortable. But if you can flip a couple at Moreno and get out of your job.
What happened? What happened?
We're close.
What?
We're getting there. We're getting there.
I love you, buddy.